Hello and welcome to Binary Options 101. This video will be discussing the basics of options. Some of you may not even know what an option is. Now, most people know of options, options trading from stock options. Now, a stock option is an option on a stock. An option is a derivative. Okay, now before you go into a deer in the headlights glaze over the word derivative, a derivative simply means a thing that derives its value from something else. Okay, in this case, a stock option will derive its meaning to exist based on the stock it's attached to, or other words, underlying stock. So Apple options, okay, are attached, they're related, they derive their existence from the stock of Apple, AAPL, okay? And so the Apple options have their own characteristics versus, let's say, Dell computer options, DELL, stock ticker symbol. Okay, those options are a lot different than Apple options. They're priced differently. They have different premiums. They have different various components that make up options pricing involved. Okay, they are different strike prices. Okay, so now I mentioned a couple things: pricing and strike prices. Yes, as you'll see, options pricing is a topic of its own, okay? But instead of trying to figure out options pricing, all you need to do is go and get some options quotes. Let's go get some. Let's go to Apple. Here at Apple, and we click on options. Did you see that? We just went to Yahoo Finance. Okay, finance.yahoo.com. Okay, let's just start over. Let's go to Yahoo, okay? And we're simply going to go over here to finance. And we're going to type in the ticker symbol for the quote. And then we're going to click on options. Okay, options, because that's what we're looking for. And you get this list of all these strange looking numbers, okay? But these numbers are the options prices. Okay, now, options expire. They expire every month. Okay, now, what even makes this a little more complicated is that different stocks have different expiration cycles. An expiration cycle means the future options out in time will be different. Okay, you'll always get the front month. The front month is what? The month you're currently in after expiration. Okay, I mean, we can still be at the end of April, and the April's expired, and then we'll get the May's. We'll just get the next available month, okay? So, when do options expire? Options expire the third Friday of each month. They disappear. You can no longer use those, okay? And, okay, so, then you always get the next month out of options for expiration, okay? Then from there it varies. Okay, so they expire every month. That's what you need to know. They expire every month. Options pricing. Okay, options. Where's the stock at right now? Okay, let's look where their stock is. The stock's at 251. Okay, 251. So let's go look. The stock's at 251. Notice on Yahoo Finance we have yellow that goes to white. Yellow means it's in the money. Okay, what's the stock price at? It's at 251. 250 is less than 251, right? Yes, so it's in the money. The stock has surpassed this strike. Okay, since these are call options, okay, the achievement is to the upside. When a stock achieves a price, a strike price, a listed strike price, 250, 240, 230, 220, 210, Okay, then it goes by 500 there. When a stock has reached a strike price to the upside, it has achieved it, and it therefore becomes in the money. Okay, let me throw something at you here. Put options. Let's flip this upside down. Now, most of you who have been in the stock market and for a while investing, not in options, you have a hard time understanding the downside. The stock market has taught you that everything's about the upside. Okay, well, we learned a long time ago that if we only relied on the upside, okay, we waste a lot of time and money. And B, if we only relied on the upside, we don't know. We know less of when to get out when the upside is over. And then C, when we learn to play the downside, okay, and then we understand that not only when an uptrend has ended, we understand the transition and when a downside move starts. And now we're able to make all sorts of money whenever I shouldn't say whatever we want, but whenever the market is moving. This is huge, okay? Because not only are we saving costs from staying in trades too long, we are even making more money from playing the downside. This is huge, okay? And so now the shift in thinking, okay, is that we're not going to be basing this on feeling. Here's how you learn to trade the downside, okay? You shift over from trading feeling or imagine stories, you thinking of a company's demise or they're not going to do so well. Okay, now if you have to think that way, okay, well, if a company's not going to do well, they're going to get in trouble, they're going to, et cetera, then of course that's negative thinking, isn't it? Right? So most people don't like that. All right, which is, hey, that's fair. Who wants to be involved in negative thinking? So we want to get out of that whole realm of guessing on, I think this stock's going to do well or poorly because of blah, 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 blah. Okay, which is, most of the time nonsense, right? I mean, you can't predict much of anything from there, nor does that way of thinking give you an accurate way of entry and exit, and we all hate to be wrong, right? So if we don't have an accurate way of thinking and entering and exiting, we're not going to exit, okay? Like a friend of mine, an old friend of mine, is telling me how they bought, they're so excited about buying General Motors at 35, thinking it was a steal. Okay, and so, what happened was that, they thought, well, General Motors, his company can't go bad, Well, it went down to nothing, bankrupt. She lost $350,000. Poof. Okay, investing. Okay, she couldn't get out. She had to win. She had to make her money back. Or whatever. We all done it. Some of us have gotten rid of that a long time ago, but you know what I'm talking about, right? It's just how it goes. It's just human nature, and we don't want to be wrong because why? Well, because we think we're going to get in trouble. Someone's going to get us in trouble. We're going to get a bad mark on a report card. We're going to get a spanking, even though we're 40-something years old. Okay, so things like that. That way of training has made us think a certain way. So it's good for some things, right? Maybe for helping you stay out of jail or something. It's good for that. But in trading, we just want to get out of that. We want to get out of that whole realm of nonsense. Okay? Now, professional traders such as myself, part of us we don't want too many people to become good traders. Why? Because if too many people become good traders, we're all going to be on the right side of the trades, which will make them the wrong side. Okay, we like emotional traders. Okay, especially in the stock market, it's awesome. We like the emotional traders because why? They fuel incredible, emotionally based, euphoric runs or fear-based sell-offs, and they make us a fortune. Okay, especially in our big trend trades, it is incredible. Okay, and that's with any market really. Stock market, you get a lot of retail traders. Okay, so so that's great. So we can ride these incredible trends in the stock market, and now, you can do that in forex as well, and futures too, of course. But the futures traders are a little more savvy. Forex is it's maturing. It's maturing. Anyways, but the stock market is with all that good story-based investing training that keeps getting pummeled into people's brains from TV. Well, it's part of me and some of my other very good trading friends. We don't mind. I hate to say that, but how about this? How about this? You can become a good trader. Okay, why don't you become a good trader? Since you're listening to me, so you can become a good trader and start winning and or netting out profits. Winning's a bad word in trading. So you can become a good trader and let those other people who are too they're not motivated enough to go get good education trading and figure it out. Let them keep funneling huge profits at the end of moves. Those are the people, and we've all done it. Okay, who buy high and they sell low. Okay, that means in a swing, in whatever, they get excited because the stock keeps going up, and that's when they buy, and then they in utter dread as the stock keeps going down against them, they panic and sell, which is usually near the bottom. Okay, so anyways, let's get back here to options. I wanted to tell you that kind of stuff because that's a big topic and it's very valuable. Okay, because I remember my transition from investor to trader. So that was a while back and that, but I remember distinctly. I remember the whole transition to playing the downside. It was like it was unimaginable. How can I play the downside? It's just I couldn't even change my investing brain around. So, but then we learned how to systems trade. Systems trade based on price. Price charts, price patterns, price breaks, trends, moving averages, bands, etc., etc. Okay, and then we converted the thinking to price-based thinking, and now there's no emotional attachment to a stock. Okay, we just trade it as a business, in, out, and out. Okay, so here, ultimately, the put side, we're going to achieve to the downside. So remember, our price was at 251, right? Let's see where we're at now. Yep, 251.19. So now we are not underneath 250. Look, the 250 is white here. Okay, the 250 is yellow here. Okay, we're in the money on the calls. We're out of the money on the puts because we're at 251. We're above 250. We did not achieve 250 to the downside. Okay, we did not achieve 250 to the downside. Okay. Now, why don't you put this on pause, go shake around a bit, stand up, clear your brain, and and then come back, and we're gonna look at some other factors of options. Okay, we're gonna go into more practical thinking. Okay, we're back. Now, an option. Okay, it's listed as this. It's listed as 4.3. What does that mean for these 260 strike calls? Okay, well, one option contract controls 100 shares of stock. Okay? One option contract. So, this will cost you not $4.30, but $430 for one contract. For 10 contracts, it costs you $4,300. Okay? So you understand that. One contract, $430. Okay? So, one contract, $740. One contract, $1,300. Okay? So we have all sorts of prices. Okay, one contract, $8,900. Okay? Why all these strikes? Well, these strikes are here and they're so far away because, well, first of all, you've had an advancement on Apple, a considerable advancement on Apple recently, so it's come a long way, okay? And so these are strikes to potentially achieve. So they put plenty out there for investors to, you know, possibly trade, okay? This is the open interest. See, open int shows how many contracts are open, purchased, okay? So you see all sorts. I mean, you have some people buying, okay, opening options positions way up here, okay? Probably a little more sellers than buyers. But we have all sorts of open options contracts, okay? That means people are trading Apple options, all right? And they're still in the deal, okay? Now, the thing about options is highly leveraged. The stock is $251 per share, okay, per one share. Now, for 100 shares is what? You add two zeros, 251. Okay, it costs you what? 250 is for 10 shares. It's $2,500. Okay, for 100 shares is $25,000. That's a lot of money for just 100 shares, isn't it? Okay, simple. Let's 251 times 100, $25,000. Okay, now that's just 100. That's 100 shares. Now to control 100 shares, right here, well, it cost us what? $430. That's a huge difference between $25,000, isn't it? It's pretty incredible. So we can get the similar benefits of controlling of this paying $25,000 in holding Apple. Okay, let's say we buy Apple and we buy 100 shares and it goes up 10 points. Well, how much are we going to make on 100 shares? Okay, times $10 per share. We make $1,000. Okay, well, let's see here. We have this 430, and the stock goes up 10 points. 430 goes to 860. 430, 860. Okay, so, well, 4.3. So 430, you make times 100. You make $430 if Apple goes up. Okay, if Apple goes up 10 points. Okay, now, why didn't you make a full $1,000? Well, you will eventually, okay, as we go further into the money. Now, that brings up another topic. Options have premium, okay? Options have premium. And options premium is, you know, it's comprised of a few things. It's comprised of time, okay? It's comprised of volatility and you know, price. You know, which usually goes along with the price of the stock, which usually goes along with volatility, right? So pretty much volatility means how much the stock moves around. Okay, so speaking of time, here are the May options. Let's go out to June. Well, wow, the 260s now cost $935 a contract versus $430. Okay, that's different, isn't it? $950 a contract versus $430. Okay, so that's pretty interesting. Let's go out to the Julys. Wow, now it's $1,300 a contract. Okay, these things tick off. They melt. Options have premium melts like ice in your hand over time. Well, maybe not that quickly, but they melt over time. And how do you determine how fast they melt? Well, you simply look at the Julys. Then you go to the Junes. So from June to July, it's going to melt about 4 something points, and then from June to May, okay, it's going to melt about 5 points. So, the thing is that it's going to melt premium value slower as you go further out in time, which is pretty cool. So you can buy options further out and have less time decay effect, okay, on the short run, because it decays at a slower rate. Now, if you hold it for a long time, and you're going to have a decay rate that will add up over time. Okay, and that's money, that's cost. Okay, you're paying for that. All right, so anyways. So bottom line is what, I can't tell you everything about options here. And I know I've already told you a lot, maybe too much, but bottom line is that you can highly leverage. And I use this word again, bottom line. But okay, to buy 100 shares of Apple costs $25,000, right? $25,000 for 100 shares. Now, what if we put that $25,000 into these options? Okay. Okay, well, we can buy 59 contracts. Okay. So we put 59. We buy 59 contracts. We go up 10 points. Okay. 59 contracts. Okay, times how much profit? 4.3. Well, it's 4.4 now. 4.4 points of profit. Okay, we're subtracting the options difference. We're going to subtract the bid from the ask. We buy in the ask, we sell in the bid, right? So 4.4, okay, times 100. Okay, since we got to bring it back to $100 contract. So, all right. So now by putting the same $25,000 in options, okay, that you would have to buy 100 shares of stock, okay, you would make, instead of $1,000, you would make $25,000. Okay, $25,000, $960. $25,960 is what you would make. That's a big difference. You make 25 times by putting all that same money in options. Okay. Now that said, when speaking of risk, let's say you drop 5 points. Let's say you lost 10 points. Well, these options are going to go down to here. Okay? So you're going to lose about over 50%. If you drop 10 points on Apple, okay, you're going to lose about 4%. Okay? So there's the other side of the coin, is risk. But the thing is that if you want big money, you need to take bigger risks that are high probability risks that can stack up over time. If you just want to be safe and just shuffle around your money and just make a little bit over time, well then, buy stock. And you can make, over time, you can make a lot of money in stock, but it's going to take a long time. If you want to make a lot of money in options in a relatively quick amount of time, okay, and people can argue whether that's good or bad, okay, whatever, you want to do something, you need to figure it out, okay, you need to figure out how to do it. If you want something, figure it out, okay, and so, and once you figure it out, you're also going to understand the risks involved, okay, and the rewards, of course. And you're gonna determine if you want that, okay? If you want that reward, and then you got to go for it. All right. And if you're willing to take that risk and lose the money, then go for it. But you can't be focused on the risk. If you're going to only focus on risk, all you're going to achieve is loss and risk. Whatever you're going to achieve what you're thinking on in trading. Okay? But if you want the profits, you have to focus on it. And you need to figure it out how to make it happen. You need to make it happen. Okay? Or you need to put yourself in position to make it happen, and the market has to give you the money. Let me put it that way. All right? So I just want to throw that in there, because if you're only going to think about risk, all you're ever going to make is a bunch of, you're going to make little gains, and you're going to take a lot of little losses because you're minding the risk. But if you want to make a lot of money, you need to go for making a lot of money. Okay? So if life is just about being safe all the time, okay, then, you're just going to pass through and do your thing, okay? But if you want to achieve something and experience, potential, really neat things, you need to go for it. And, and then you have to measure. I mean, depends on your where you are in life. If you're married with kids and this and that, you have to figure stuff out. You need to make sure that, what's the additional risks there, okay? So you can't go, you have to think, well, what are you willing to risk? Really? Because you have to be honest with the risk. When you're honest with the risk, then you can move forward. And then it's your decision, and you're willing to live with the consequences if it doesn't work out. But you have to, your mind has to be 100% focused on achieving what you want. Okay? When you're 100% focused on achieving what you want, risk is factored in there. Okay? Risk is factored. And you have to be, if you're gonna half and half, then you're not gonna have great results. But if you're 100% to what you want, and you're just gonna go for it, then you're gonna be the person who can achieve great things. It's like faith. Okay? You can't doubt. And then if you don't doubt, you can have amazing things happen. Okay? Now, I'm not saying, invest mindlessly and just say, well, I believe this is going to work out because, I'm feeling special. No. You're taking a high probability business risk. Okay? That's what you're doing. And even better, instead of trying to go for one big kill, why not get a trading system? So your trading system can net out a big kill over time. That's how, if you go study some traders, go study the market wizards, okay, Jack Schwager, you'll see how traders matured into trading a methodical way, okay, turning trading into a business, calculating their risk, getting out of the whole trading by feeling game. And then getting out of the whole emotional satisfaction from trading, then turn it as a business like they have a grocery store business. Okay? Do the deals. Okay? So, anyways, I want to put that out to you. If one of the greatest traders of all time is Richard Dennis, who turned $400 into $200 million, okay? If his system, according to one of his top students, Russell Sands, won only 40% of the time, means it lost 60% of the time. And he made some of the greatest profits in trading ever. Then percentage-wise, then that guy's the guy to watch. Okay, and then you're gonna get some secrets. Okay, turtle traders. There's tons of info out there these days. Okay, so anyways, on the turtle traders, and even in the bookstores, Barnes and Noble. Okay, very interesting, right? Anyways, so these are options. You can use leverage. Okay, there are options on futures. There are options on forex. Okay, just normal options. Okay, but binary options, they give you a fixed value, and you make it or you don't. Okay, and that has its advantages. So we're going to move on, and I hope this helps give you a little bit of understanding on options, and thank you.